do I believe with Die With Nothing? Well, everyone's got a different perspective on what they're trying to do on this planet. To me, I want to leave the place better than I found it.
Mm-hmm.
My favorite way to do this is through life insurance. I make no bones about this. Think about it. It's basically a permission slip to spend all your money. If I spent all of my 401k money and croaked, my family gets nothing.
Mm-hmm.
If I spent all of the cash value out of my life insurance policies and I croak, my family gets several $100,000, several $1,000,000 after I spent all my money. So wouldn't that be, just think about it logically for a minute, wouldn't that allow me a permission slip to spend everything I have and then use the death benefit to replace whatever I spent to give to the next generation?
This is the Buried in Work podcast, where we share tips and interview experts to help you simplify estate planning and end-of-life tasks.
I'm your host, Adam Zuckerman, and today we have a very special guest, Mark Willis. He is a certified financial planner and the owner of Lake Growth Financial Services in Chicago, Illinois. Mark is not your average financial advisor, though. He has helped hundreds of clients grow their wealth through innovative tax-efficient strategies like self-banking and real estate investing. But he also has a very special interest in helping people get through retirement, end-of-life tasks. Mark, great to have you here. Welcome to the show.
Thanks, Adam. Thanks for having me on.
Yeah, let's just hop in a little bit. So what's your background? How did you get to where you are? And then we'll go from there.
Yeah, so it's sort of a surprise, but I've been privileged over the last 12 years now to work with real estate investors, business owners, highly paid W-2 employees, business executives, and even some NFL Super Bowl champions. But most people I like to work with are just people looking for more certainty, agency in their life. More people are coming to us now saying, Mark, whatever we were doing got us feeling like just a tennis ball floating down the gutter of life, and we want some more assurance that what we're going to plan for today will come to pass, both in our lifetime and beyond our lifetime. And so part of my work and my privilege is to get to serve families and business owners to help them reach their financial milestones without taking a bunch of unnecessary risk. I believe in risk. I'm a financial advisor. I'm a business owner, but I'm not 18 years old anymore. I know that I can get there without taking unnecessary risk. I'm going to try to do that all day long. So that's what we get to help folks do.
Is that what the bank on yourself strategy on the website is about, or is it something different?
Yeah, something that I find, I'll give you the slightly long answer, and I'll try to keep this as short as possible, but people can put their money just about anywhere. There's literally thousands of different financial tools and vehicles, and multiply that by millions of strategies. It can be overwhelming on where you should put your money. And I have found over the years that more people are simply doing what they've been told to do with their money. And yet their beliefs do not align with their actions. And that causes stress. I want a 6-pack of abs, but I also love ice cream. So, my actions and my beliefs might go counter to each other. And this is true with your 401k, your IRA, or the typical conventional places people park their cash.
Mm-hmm.
They believe that tax rates will go up for them in the future, and yet they're putting as much as they feel like they can into their 401k, which is going to get taxed in the future. To me, that's like deferring a root canal. It just gets worse and worse the longer you wait. So think carefully about what you want your money doing for you. When I ask my clients this question, here's a few things they come up with. I wonder if you'd add anything to this, Adam. They say they want some certainty in their cash. They say, for business owners especially, they want liquid access to the money. They want to be able to see it grow with certainty, some sort of decent rate of return that beats inflation. They want to be able to get the money out tax-free. They want it to be safe from creditors, and they want it to be beyond the reaches of the estate tax. I mean, this is sort of my short list, but would you add anything to that? Anything that comes to mind there? If you could paint with a broad brush there.
For the purposes of Buried in Work, I think that having assets that are easily transferable and known for your family members or loved ones or heirs is probably important to add to the list.
100%. Yeah, my mom died a few years ago, and she just barely got the will and the trust done before she passed away. Thank God. It made everything a lot easier. And certain things, as you know, avoid probate, right?
Mm-hmm.
So if we can avoid probate, that just makes the whole kit and caboodle a lot easier when helping, with that transition. So of all things in the financial universe, Adam, I stumbled across a tool called, we refer to it as Bank on Yourself type whole life policies. So these are a certain form of whole life insurance that are designed specifically to do a lot of the things I just mentioned. A couple of quick ones very quickly. The cash value on the life insurance grows guaranteed every single year, no matter what the stock market does. Contractually increasing in value every single year, regardless of market conditions. Sounds pretty good to me. I have liquid access to that money. So if I've got 400 grand in my cash value, certainly I can grab that money and use it for kids' college, real estate deal, pay off some debts, pay off my house if I needed to. It's really your personal decision how you spend that money. It's a liquid asset. It's a current asset on your balance sheet. You could even use it to invest. A lot of our clients are using their cash value to make other smart investment decisions.
How is that different from a high yield savings account then? If you can access the liquidity any time and take it out, what's the difference?
Yeah, great question. So, what's the advantage of cash in a high yield savings? Well, the high yield savings gets a decent rate of return. Whole life insurance would beat that high yield savings in terms of a rate of return over a long period of time. That's the first one, so a better rate of return. Second, it's a tax-free return, whereas a high-yield savings account will be taxed every single year. And if you're like most of our clients, you're hitting those higher tax brackets with your income. So a 5% high-yield savings account, for example, is going to get dinged on a tax basis, whatever interest they happen to pay you at the bank. And you're going to end up not with 5% at the end of the year, but maybe 3.5% after tax, right? Life insurance doesn't have that problem. Third and final answer to there's several more answers, but I'll keep these brief.
Yeah.
The death benefit. There's no death benefit with a high yield savings account, which is, by the way, going to be income tax free to the family. And as we talked about earlier, it'll bypass probate.
Explain that a little bit. So when you think of death benefit, typically people might think, okay, so the value of whatever the holding is transfers. You can have a payable on death beneficiary. And obviously, the money just doesn't go back to the state or go back to the government. It will go through the processes of intestate in the jurisdiction where you live, even if you don't have a will. So how are you drawing that comparison between no death benefit? Because it's not like the money just disappears.
Sure. Well, if I've got, let's say, $10,000 in my high yield savings account and I pass away, my family's getting what? They're getting $10,000. If I put $10,000 of my money into a whole life policy and I died tomorrow, my family's getting, depending on my age, 50 grand, 150 grand, income tax free.
Oh, wow. Okay.
Yeah, so that's a big deal when it comes to helping liquidate or create an estate for a lot of families.
Are there time limits? You have to sign up for X amount of time and it's locked, or can you pull out anytime you want?
Anytime you want. It's your money. There's no liquidity limitations like there are with CDs, for example. You put the money in. We just had a client, he dumped in a chunk of money, a large chunk. It was, in his case, a big chunk of his portfolio. He dropped in several $100,000 into a single premium whole life policy. And within about 2 or 3 weeks, he was borrowing against that. And that's something I'd love to chat with your listeners about. You can borrow against the life insurance, and he was using that to go invest in some real estate. Now, the interesting thing about this, Adam, and we'll get to the downsides too, there's no perfect financial vehicle out there, but when you use this policy as collateral and you are able to borrow against this policy, you are in essence your own banker. This is the idea of bank on yourself. And again, a high yield savings account doesn't let me do this. I still gotta, if I have a high yield savings account and I need a loan, I gotta go kiss the ring of the banker, But when I have a whole life policy that's designed this way, I can go online within about 2 minutes, request a loan against my life insurance, and within about 4 or 5 days, the money hits my bank account as a direct deposit.
Where's that marketplace taking place? Is it from the provider? Is it from a broker? Is there an entire ecosystem that people don't know about?
Great question. Yeah, this is within the insurance company's own online portal. Usually they have an online website. You can just, if you are a policyholder with again, it's got to be correctly designed. You can simply log into the insurance company's website, request your money, and they don't ask any credit check questions. They're not looking to what are you going to use it for? They ask you, how much do you want and which bank account do you want us to send it to? And no approval process needed. The neat thing about this, and then I'll hush and get your feedback. Let's say you've got, let's pick a number, 100 grand, $100,000 in cash value. And let's say you borrowed out $80,000 to buy pick whatever you want, an investment property or a nice car or something. Let's say it was a nice car. The policy itself, after you took the loan out, you took a loan for 80 grand, you had 100 grand in cash value. The policy continues to grow and compound on that guaranteed basis on the entire $100,000, as if there was no loan.
So why don't people just put in $100,000 or even $1 million or $5 million, whatever is available, take out a significant portion of it, drop that in a high yield and double up?
Some people do. Some people do. So there is interest on policy loans, but typically the growth is greater than the interest that you're charged. Over time, the policy's interest rates over let's say a 4-year period in today's rates might be about 2.5% APR. But the growth on the policy plus the high yield savings, that's a great combination as long as you're sophisticated enough to pay yourself back on your own terms. And that's the other piece. You can repay this loan or not. I encourage my clients to repay the loan. That way the money's back in there so you can borrow it out for the next car or the next real estate property. But even if you never paid off the loan, and let's say I did this and I died yesterday, my family would get my entire death benefit minus any loan that was on the policy. So they might get, let's pick a number, 500 grand of death benefit minus my $80,000, and I'd get my brand new car. So, I'd much rather stick on this side of the grass, thank you very much, and not croak. But if I was to pass away, my family would get the full death benefit minus any loan against the policy.
What are some of the downsides? Because this almost sounds too good to be true.
Yeah, I'm glad you asked. I was about to get there.
Yeah.
So obviously this is an insurance contract. So a few things. It's not an investment. So don't treat it like a brokerage account. It's never going to give you double-digit rates of return. It should be seen as a cash alternative. It's a savings alternative. It's a life insurance contract. So that's the first. It's going to give you middle single-digit rates of return. Now, those are tax-free returns. Okay, so, if you're getting 5% on a whole life policy, that would be equivalent to maybe, depending on your tax bracket, 8 or 9% in a 401k. Okay, so that's not bad, but, it's never going to be 33%. So that's the first consideration. The next would be there is an insurance expense. You are buying a death benefit, so if you put in $10,000, let's say in the first year as premium, you're going to have less than $10,000 in the first year or two. As you make that contribution, you're buying that death benefit. You might have somewhere between $6,500 and $8,500 of cash value in the first year. So you're going to see that cost show up in the first 2 or 3 years. Now, this is way more efficient than our grandpa's whole life policy that he bought, 100 years ago. These policies have become a lot more efficient. And again, I got to say it one more time, the biggest risk, if you bought a whole life policy or worse, an IUL policy or VUL policy or some other derivation from somebody that didn't design it properly, that's probably our biggest risk here, Adam. I've met a number of people who thought they had one of these things. They heard about it on YouTube or whatever. And I look at the paperwork and it's a mess. It's a tax nightmare that's riddled with commissions. So the biggest consideration, biggest risk is making sure you've got an advisor who's on your side of the table and knows how to design these things properly.
How does that work then? So it sounds like there's a marketplace where you can go on your own, go to the website, sign up. You may or may not get the policy that you think that you're getting. When you work with an advisor such as yourself, others, and obviously everybody can set up situations differently and unique to their own circumstance. How do those arrangements typically work? Is it hourly? Is it a percentage? Is it something else altogether?
Yeah, really thoughtful question. So if there's one thing I'd say for folks to dig into, you're right. We are certified and authorized by a certification program known as the Bank on Yourself Professionals. And there's about 200 advisors around the US and Canada that do have quality control, kind of looking over our shoulder. We've got, a group of advisors that look into our business to make sure we're doing these policies correctly. So there are 400,000 life insurance agents out there, but again, if they're not designing these things properly, it's sort of like a heart surgeon. You don't just want the nearest, closest heart surgeon to operate. You want to get the best one. So make sure you're working with a Bank on Yourself professional. You can search for that, or you can go to my website, which is kickstartwithmark.com. I'd be happy to chat with you, or you could go to look up Bank on Yourself professionals in my area and see what comes up.
Who's the certifying body behind Bank on Yourself professionals?
Yeah, 25-ish years ago, there was a certification program born out of some of this frustration. A lady named Pamela Yellen, who's written several New York Times best-selling books on the topic, she had the problem of getting several life insurance policies poorly designed. So her and another gentleman named Nelson Nash created a certification program around the turn of the century. And since then, it's been the only governing body that has any kind of certification. It took me about 3 years to get my certification. It's about as tough to really become an expert at this as it was to become a certified financial planner.
On the website, you talk a little bit about tax strategies, diversification, of why tax-deferred accounts can be problematic. Let's get into that a bit.
Yeah, you're right. So tax deferred is an interesting word. A lot of people hear that word and it sounds so nice. But we all have to think about that. Again, deferring a bad thing can sometimes make it worse. You know, if you defer an argument with your teenager, it's probably going to get worse. If you defer a root canal, it's probably going to get worse. So think carefully about, when do you want to pay those taxes? When do you believe taxes will be at their lowest? Look into our history and then consider, are we in a low bracket environment or a high bracket environment right now? Most people say that when they really look at history, that we're in a pretty low tax environment today. And then they look into their future and they say, wow, look at the impending debt. Look at the impending government programs that don't have a process for paying for itself. Where are they going to get the money? Are they going to pull money out of people's accounts that don't have much saved? Or are they going to look at the $34 trillion in 401ks and IRAs and say, that looks good?
Are you talking about, when you're talking about the framework, your individual tax burden, or are you talking about the tax burden of government? Because those are two completely different, and they could be the same in track, but they are two different metrics.
Yeah. So you're right. Certain people, there's a very small slice of people who will probably be in a lower bracket in retirement. I hope that none of my clients are, and here's why. That means I failed them. It means that they're making less in retirement than they were during their working years. I want you to get a pay raise after you leave the day job, so to speak. It also presupposes that tax rates do not even increase by 1% in the future. And we all know that next year, unless Congress acts, we all get a tax raise of 10% on our money due to the Tax Cuts and Jobs Act expiring at the end of 2025. Isn't that the same as a tax raise on all of us? So yes, you're right, the government itself, but who are the government? Well, we, the people, are the government. And so if they are in debt, we are in debt. Each family owes a little over $250,000 in debt right now. And where are they going to get the money? Are they going to pull it from people who have nothing saved? Or are they going to pull it from the assets and the account values in the 401ks for those that were smart enough to save? And my last question is, Adam, do you want to pay those taxes if they go up even 1% higher in the future?
Ideally not.
Yeah, me neither. To me, it's a question of pay tax on the seed or the harvest. And I'm good either way. There's the rare case. Here's the one example of someone who should be maxing out their 401k, in my opinion. And by the way, even the father of the 401k, Ted Benna, has come out and said he regrets it. He says it's become a monster. And it's only since 1981 we've even had a 401k. That's not even old enough for the 401k. If it was a human, it wouldn't even be old enough to retire itself yet. That's how young the 401k is. So anyway, the 401k example where it makes sense would be someone who's making a lot of money today, but has nothing saved. So maybe they're like a 55-year-old dentist who maybe just lost everything due to a lawsuit or a divorce or something. If he's starting at scratch level and when he's 55, that'd be a great person to, and we set up, those tax deferred vehicles as a financial planner. I'll set that up for that particular person. I just don't want to paint with a broad brush and say everyone should get a 401k or not, right?
So in the event that you are that 55-year-old dentist that just started that process of rebuilding after whatever the event might have been, at what point in time do you go, okay, you've got enough money in that 401k, you've been doing this long enough, you've got enough saved, stocks, bonds, whatever, to start diversifying? Where's that tranche or that tier?
Well, great question. So look at the future retirement income that he might be able to pull from that 401k. And this is another problem I have with traditional, conventional retirement accounts. They're actually 4 flat tires, but to the financial vehicle of the 401k and IRA. One of them is there's no guarantees. Two, there's no certainty about how much you should pull out of that 401k when it's time to retire.
Mm-hmm.
So let's say he builds up $1 million in his hypothetical 401k. Could he even do that due to like government restrictions on contribution limits and the time he has left before he retires? He probably couldn't get $1 million in there, but let's say he did. So $1 million now, he's 65 years old now or something. And now he has this question mark above his head. And his question mark says, how much is the safe amount of money I should pull out of that 401k so I don't outlive the money before I croak?
Mm-hmm.
No one can answer that question.
Do you believe in Die With Nothing? Or are you trying to
I've
recommend
got the book
that
back here. Yeah, but Die With Zero by Bill Perkins. Yeah, I got that book back there. Do I believe with Die With Nothing? Well, everyone's got a different perspective on what they're trying to do on this planet. To me, I want to leave the place better than I found it.
Mm-hmm.
My favorite way to do this is through life insurance. I make no bones about this. Think about it. It's basically a permission slip to spend all your money. If I spent all of my 401k money and croaked, my family gets nothing.
Mm-hmm.
If I spent all of the cash value out of my life insurance policies and I croak, my family gets several $100,000, several $1 million after I spent all my money. So wouldn't that be, just think about it logically for a minute, wouldn't that allow me a permission slip to spend everything I have and then use the death benefit to replace whatever I spent to give to the next generation? In fact, that's what our clients do.
And I think it's a great idea. I mean, leaving something for heirs, loved ones, is a noble legacy to aspire to. Let's take that concept and put it into tangible terms that people can understand. So if you are, let's say, 50 years old or 40 years old, and it gives a little bit of time for your policy to mature and grow and do what you need to do, what are you looking at in terms of starting costs, monthly nut, things of that nature to actually position the family in a good spot? So let's give actual tangible numbers, examples of what somebody might expect.
Yeah, sure. So, you're looking at someone in that 40 to 50 range. Is that kind of what you're
Yep.
looking at? Okay. Yeah, everyone's going to have different numbers, and it's going to be based on your age, your gender, your health situation, and more. But, think about what this could do if you could set aside, pick a number. Let me see if I can pull one up for us for our conversation without numbers or names or information or anything.
And you can baseline it, say like healthy male
Sure.
or female, 45 years old.
Mhm.
The normal things. Drinks every once in a while, doesn't smoke, 3.2 kids at their house or whatever that number is.
That's great.
Yeah.
Yep. So here's somebody that I won't put any name or information on, but somebody who's 49. This person is able to set aside $60,000 a year.
Okay.
Now, please understand, you could take a zero off of that number, or you could add a zero onto that number, and everything I'm about to share is exactly proportional. Okay.
Mm-hmm.
So male, 49-year-old, is able to save $5,000 a month, $60,000 a year. All right. So, this person has a death benefit on this policy. And my job to design this properly would be to cut down that death benefit as small as I could make it in our example. So think of the design of this sort of like a seesaw. We could put $60,000 into a highly commissionable, big death benefit policy, and there would be zero cash value in the first few years of this policy. And you might have a $4 million death benefit in that case. What I did in this person's example was I cut the death benefit from $4 million to $1.3 million to start.
Mm-hmm.
That cuts my commission down dramatically, okay? But it gave him $39,000 of cash value in year one. Now he's using that policy to pay off some credit card debt and to set up his business for success in 2025 next year. The nice thing too is over time, the policy death benefit will grow. By year 20, he has a death benefit of $3.2 million, and he's got a cash value at that point of $1,650,000. Now he's only put in a lot less than that, but he's got a $1.65 million liquid account by which he can borrow against, buy stuff with. His plan is to use it for business equipment in his business.
So is this being funded by him individually after paycheck, or is this viewed as a business expense and perk?
His case, it's after expense, personal funded, but you could own this within your business, and a lot of clients do. Yeah. So in fact, his desire was not just to use it for business purposes, but also personal. So he has 3 children, and his plan is to borrow against this policy to pay for his kids' college. One of the nice features about this, Adam, is life insurance. Talk about camouflaged assets. We like the death benefit because it doesn't go through probate. We talked about that. But life insurance cash value also doesn't show up when you apply for college and financial aid for their kids. If he had all that money in a 529 plan or a college savings account, that would all get counted against him when he went to apply for, grants and scholarships. So yeah, he personally owns this policy out of those reasons. But the death benefit grows. Again, $3.2 million is not too bad. He's got $1.6 million after setting this up 20 years previous. And he can typically take about 5.5% of that money out in retirement. So just to give you a quick idea, what is he could pull about $91,000 a year income tax free for the rest of his life, starting at age 69, live in the next 25, 30 years, and he'd still have a big death benefit to leave in retirement. So what did he lose out on by doing this? Well, maybe he had some FOMO with the stock market, Maybe he would have less to talk about at the barbecue with his buddies who might have invested in NVIDIA or, the next meme stock. But as his policy begins to build, like by year 4, he's got $209,000 of liquid money. Couldn't he use that to invest in whatever looked good to him at the time, whatever opportunity came across his desk? Stocks, real estate, business and equipment, whatever comes across his desk.
And just to be clear for the listeners, so let's say he takes out that $200,000. He tries to go after that next meme stock and loses everything of that.
Yeah.
What happens to that policy?
Yeah. Well, at that point, just to give more numbers, because I know your audience likes some technicals. At that point, again, this is in year 4 now. So we're going back to year 4. His death benefit has grown from 1.3 to 1.67 million, 1.67. He's borrowed against it $200,000. Remember what's happened here. The policy is still growing and compounding on the full $209,000 of cash value. Even though his meme stock went to 0, he had a stop loss. His policy is still earning interest as if there was never a loan taken, even on the capital he borrowed to invest in, Pets.com or Enron or whatever he bought. Now, his death benefit has been collateralized by that loan. So if he croaked that afternoon, hopefully he doesn't, his family would get 1.67 minus $200,000. So he'd leave his family 1.4 million and a bunch of worthless stock.
You can never exceed the amount in it, so there's always at least a benefit of some sort, if
That's
not
right.
minor.
Correct. Yeah, you can never be upside down or underwater with your life insurance. This is why this is different than, say, like a home equity line against your house. Right. Great point, Adam.
Last question on that rate, and then we'll shift to something else.
Yep.
We have a checklist that is the steps to take after someone dies. It's about to turn into the end of life checklist. And we helped one individual save $403,000. And the reason why is their husband was in the hospital. They weren't paying their bills. The checklist said, make sure that you go through all of your expenses and flag the important items, check when those policies are due to make sure that you're not missing any. And it turned out that the policy was going to completely lapse in 2 days.
Wow.
She called, got an extension, overnighted the check. The husband passed away a week or 2 later, and she was able to file for $403,000, which she would have lost.
Wow. That's a big deal.
Yeah, very big deal. What happens if you stop paying on one of these policies by accident?
Yeah. Okay. Wow. Certainly. What huge value. She will tell her friends and family. I hope everyone, comes to you because of that, because that's incredible. What a story. I've had, unfortunately, heard the story on the other side where they didn't get that renewed. So it's a big deal. Okay. So let's use this same guy's example. Let's say in year 4, again, he's got $209,000 of cash value and $1.6 million of death benefit. Let's say he can't be found. Maybe he's on a business trip, or maybe he's doing a mission trip to Africa. He's off the radar somehow. Maybe he's sick. Who knows? But he's unable to pay the premiums out of his own pocket. Again, he's putting in $60,000 a year. Well, what if he loses his job, or what if he can't pay the premiums for any reason? First of all, the majority of that premium is completely optional to him. He can lower it down, and the insurance company has instructions to automatically lower it down to $20,000 instead of $60,000 should he be unable to pay the $60,000. So 20 grand is a lot easier to pay than 60 is, at least in my world. Now, what if you can't come up with 20 grand, Mark? Heck, what if you can't come up with $2 to pay this thing? What if we're just unable to pay? Well, what did he have in cash value? Oh yeah, $209,000. Where could we possibly come up with some money to maybe scratch together some funds to pay that premium? The life insurance, that's right. So you could borrow against the life insurance in a tight spot. I've done this in years past. Borrow against the policy to fund itself.
But you
don't
can
want
only
to make
do
a
that
habit
for
of
so
that.
long.
Yeah,
What if he loses his job or he's disabled for some reason, and
Sure.
that income stream that he had forever is now gone, and
Yep.
he dropped it from 60 to 20, from 20 he then borrowed against the policy, he paid that
Yep.
for 3 years, and then he goes,
Yep.
uh-oh, I'm out, I
Yep.
can't borrow anymore. What
He'd
happens?
still have 130 to 140 grand by which to do something with, So
Okay.
let's go worst case scenario to more likely. Worst case, he cashes out the policy and walks away. He gets 130 grand in his pocket.
Yep.
Not a bad deal.
Mhm.
He loses the death benefit, but he has that money to survive. Next best option, he can, again, let the policy cover itself for another 7 or 8 years, right? He's got plenty of time to do that. Another option is a strategy known as reduce pay up. And while your listeners may not care to hear all the details, basically what it does is it takes the 130 grand that he still has in cash value, reduces his death benefit down such that maybe it's 800 grand still or something, and he never has to fund the policy ever again. Guarantees that the policy is paid up. And while he doesn't have his big death benefit, 1.6 million, maybe it's been lowered to 800,000. He still has 130 grand of cash value. He never has to pay for the policy ever again, and it grows guaranteed for the rest of his life.
And that's one of the reasons why you want to work with an advisor, to make sure that you understand all of these options.
That's right. And our podcast, Not Your Average Financial Podcast, one of our recent episodes, we went into 6 different ways, if you really want to know, on what you can do if you can't pay those premiums. This is not supposed to be painting you into a corner. It's supposed to give you the liquid access to the money, so you got more options, not less.
All right. Mark, this has been great. If people want to find you, where do they go?
Thanks, Adam, for the opportunity. Yeah, we've had so much fun. I've been having a great time. I hope you have too.
Yeah.
If folks are looking at this tool, that's great. We are a full financial firm, but it's a tool I think, especially on the estate side, folks should at least know about. It's a way to live your life insurance, if you will, to become your own source of financing. If you're sick and tired of playing with the bank's games and kissing the ring of the banker, and if you're wanting to find some more certainty in your financial future, we can help. You can go to kickstartwithmark.com, kickstartwithmark.com. We just do a 15-minute phone strategy session, answer your questions, and see if this would be a right fit for you. And if so, we'd take the next steps from there. So that's kickstartwithmark.com.
All right. And for those listening, Mark does have a podcast. It's called Not Your Average Financial Podcast. We will link to it in the show notes as well. Appreciate your time, and we'll get you on the next episode. Thanks so much.
Thanks for listening to another episode of the Buried in Work podcast. Remember, you can save 10% on our estate preparation package and games with code podcast10 at buriedinwork.com.